Okay, sale of a personal residence. So this is another um, transaction that can result in tax savings. So Richard and Sherry have a basis of 300,000 in their home. They recently sold it for 800,000, a long-term capital gain of $500,000, and because it's their personal home, this is $500,000 tax free. So we need to celebrate here, and that celebration deserves more than one slide. So we are celebrating. Now, this is a Section 121 exchange, which is gain on the sale of a principal residence. So gain can be exempted from income up to $500,000 for qualified married filing joint or $250,000 for all others, which, for most people, this is going to mean all of the gain is excluded from income. So this is great. Now, requirements for gain exclusion: the home has to be owned and used as the principal residence for 2 out of the last 5 years, and a 1-year stay in a nursing home facility counts toward the 2-year requirement. So there's a little bit of flexibility there in determining if you're in the home or not if you have that unfortunate situation. Now, the exclusion can be used only once every 2 years, which actually is pretty often. Most people have no desire to move any more frequently than that. Now, this is owned and used as the principal residence for 2 out of the last 5 years. It doesn't have to be the last 2 years out of that 5-year testing period. Rules for spouses: for married filing joint, the exemption is $500,000 if either spouse meets the 2-year ownership requirement, both spouses meet the 2-year use requirement, and neither spouse is ineligible due to the sale of another principal residence within the prior 2 years. So 2-year limit. There you go. There's also situations where if you're not in there for 2 of the last 5 years, you can get a partial exclusion, and a taxpayer can qualify for a reduced exclusion if the sale is due to a change in employment, change of health, or other unforeseen circumstance. So I think the book does a pretty good job of explaining this. So read the details from the book. Also note, if a home used as a taxpayer's principal residence was acquired in a like-kind exchange within 5 years of the sale, the Section 121 exclusion is not available. So if it was acquired in a like-kind exchange, then that means at the time, if it was a like-kind exchange, it was business use property or property held for the production of income. So that's a little exception there. And Section 121 does not shield depreciation recapture from the income tax. So recall in our video about the taxation of Section 1231 realty, there is some depreciation recapture. Converting a rental to a principal residence. So if you do this, some gain will be taxable. Seth purchased a home 10 years ago for $200,000. He rented it out the first 8 years, and during the rental use period, Seth claimed $58,000 of straight-line depreciation. Now, 2 years ago, the tenant moved out, and Seth converted the property to his personal residence. He sold the property after 2 years for $550,000. So, good for Seth. So, the amount realized was $550,000. His adjusted basis in the home was $142 because of that depreciation. And so he had a total gain of $408,000. Now, how is this going to be treated? Because it used to be rental property and now it's personal residence property. So here's how it's going to be treated. So the first $58,000 of gain is going to be depreciation recapture, and it will be taxed at 25%. And so the tax will be $14,500. And don't forget, the NIIT applies to this because this is considered capital gain. Okay. Go down a line here. We have non-qualified capital gain of $280,000. Now, where did that number come from? The non-qualified capital gain, you take the gain, and you're going to multiply it by a ratio of the non-qualified use period over the period owned. So the non-qualified use period was the 8 years it was a rental. The period owned is 10 years. He's owned it for 10 years. Now the gain, we're not going to take the $408,000. We're going to take the $408,000 and we're going to subtract the $58,000 that was taken as depreciation, because what we're trying to do is take the remaining gain after the depreciation is recaptured and divide that between qualified and non-qualified use treatment. So this is where we get the $280,000. Now this is going to be taxed at 15%. And so the tax on that will be $42,000, and again, subject to the NIIT. The remainder of the gain, the $70,000, this is what's going to be qualified gain to be excluded from taxation. Yay, due to Section 121, and so it will be taxed at 0. So he had total capital gains of $408,000, and his tax was $56,500 plus the 3.8% NIIT, which he should certainly qualify for with that large of a gain. Okay, converting a principal residence to rental. Now you can lose all the exclusion. You can keep all the exclusion or you can lose all the exclusion. So this is something that's very important to make your clients aware of. So here's our example here. Dorothy owned and lived in her principal residence for 10 years. She bought the home for $150,000. At the time she moved out, it was worth $200,000. When she moved, she converted the old residence to a rental residence. Dorothy sold the old residence 5 years later for $250,000. Now, all of the gain will be taxable as a capital gain, just as if it had always been a rental. Why? Because for that exclusion, you have to have owned and used it as your principal residence for 2 of the last 5 years. But she rented it out for 5 years, so she is not going to get an exclusion on any of that gain. None of the gain will be excludable because Dorothy did not meet the ownership and use test at the time of sale. Now, if she had sold the home within 3 years of converting it to rental, she would have met the ownership and use test, and all that gain would have been excludable. This is just a link to I think a very good article. It was written a few years ago, but it's still relevant. These laws have not changed. And if you notice, even the $500,000 and $250,000 exclusion is not being indexed. So those numbers are still good. And the link to this is also in your module. So income tax planning principles: reduce gross income. Don't convert a highly appreciated home into a rental property and lose your tax-free gain on sale. Buy another property to be your rental property. Okay, reduce gross income. Try to establish the more highly appreciated home as a principal residence to exclude the highest possible gain. So this can be relevant when you have clients with more than one home. So for example, Jack and Beth are high-income clients with 2 homes. Home A is a luxurious home in the mountains in a secluded and exclusive area of Idaho. Home B is their very nice home in town in Missouri. Now, Home A is expected to appreciate much more rapidly than Home B. So they may be able to establish that Home A is a primary residence and treat the other property as a vacation home, because this exclusion does not apply to vacation homes. It only applies to your principal residence. Now, to establish their property as a primary residence, they would need to become a resident of Idaho and use that address as their mailing address on credit cards and such, and spend a lot of time in Idaho. Now, this option is more likely for retired individuals who spend a lot of time at Home A. So, you know, if they have jobs in Missouri that they have to go to every day, then they probably won't be able to do this. But you can have clients that can do this, and more people are working from their homes remotely, and so you could have a situation where they could establish Idaho as their primary residence. And if it's their primary residence, that obviously doesn't mean they can spend no time in Missouri. So, just watch for that situation if it arises. Um, so for clients with several homes who are wanting to sell, the homes can be sequentially treated as primary residence. So Mickey and Roger have 3 homes, a primary residence and a vacation home in California. Both are in they're all in, I think this slide should say that they have 2 homes. So both homes are in highly appreciating markets. Now they have a long-term plan of selling these homes and buying a luxurious home in exclusive part of the French Riviera. So what they can do, it, if this works out for them, they can sell their primary residence at a tax-free gain, assuming all the qualifications are met, and then they can move to their vacation home and establish that as a primary residence. Now, after they've met the exclusion qualifications for the exclusion of gain on this new primary residence that used to be their vacation home, they can sell and get tax-free gains. Now, the gains will be prorated for the time it was their primary residence versus vacation home. Nevertheless, they can exclude the gain, some of the gain. So there's also sometimes you could have clients that this could be beneficial for.